So let's begin with the big issue, China pushing back.
With China's currency weakening this morning, it does look to be the next salvo in this.
Direction of travel, not surprising, but the magnitude, yes.
This is a very strong message from Beijing to Washington.
The central bank is going to have to be very, very careful how they manage it.
If the PBOC does stabilize the currency over the next week or two, I think we can avoid the currency war.
Equities are going to get hit here simply because traders and portfolios are going to have to short something.
It's a very, very clear signal, and market has reacted accordingly.
It's an escalation. I think that's the key thing.
Really, we've probably been speculating about some resolution to this a bit too much.
For investors who, for most of this year, have been putting, I think, trade wars into the box where at some point we will get a resolution that will be okay for markets, I think this raises a pretty major question mark.
So the key question for trade negotiations, just where is the off-ramp? Joining me around the table, Paul Richards of Medley Global Advisors, Patrick Palfrey of Credit Suisse, and Gina Martin-Adams of Bloomberg Intelligence. Gina, good morning. Let's begin with you. Where do you start this morning?
Yeah, it's a little bit of an interesting start to the week, right? To me, this looks exactly like May in repeat. So August looks like we're set up to be a month in very similar fashion to May. In that time, the Chinese RMB also spiked. You saw a pretty big move in early May, certainly affiliated with more tariffs activity, more tweets from the president, very similar to what we saw late last week and into today. Defensive stocks still performing better than the rest. The difference is the vicious move in the bond market. I mean, in early May, you didn't see such an extreme rally in yields globally. You did see yields sort of melting lower, but you didn't see this extreme rally. So obviously, this has a little bit more of a risk-off tone even than early May did. But otherwise, it's very similar. Timing similar. It's at the end of earnings season. So we just sort of see the earnings start to tail off, and we're in this air pocket of information, and we focus again on policy, creating volatility for stocks.
And we get some big moves in the bond market too. We are down by about 11 basis points at the front end of the curve. Futures negative 1.5%. Patrick, what's the message for clients this morning?
I mean, the message for clients this morning is whether or not this is going to have a catastrophic impact to the U.S. economy. Historically, when we've had these discussions, it's been somewhat limited. The question is whether or not this is going to crack confidence. And up until this point, we haven't seen confidence get cracked, whether it's small business, whether it's companies willing to invest in CapEx. So that's why equities have continued to do well, despite the fact that we've had all these trade discussions.
And finally, a big move in the FX market. For a long, long time, the Chinese constraining Chinese currency weakness, now starting to tolerate it a little bit, Paul, with a signal overnight with a weaker fix. Your message this morning, what is it?
My message is China's in the game. Trump has gone too far, and China said that is it. So from their perspective, fixing it at 692 was smart. And they're now saying, well, look, I actually think what we need now is diplomacy. We've now got two big guys just standing off against each other. And China could fix that thing under 690 tomorrow and resolve this, but they won't. And Trump can't go and intervene in their currency. And they've hit him right at the sensitive point, which is currencies. So it's a brilliant move by China, and I think it brings them both ultimately back to the negotiating table, and I think September 1 passes with no tariff.
Well, Paul, let's talk about that. You say that it's a brilliant move by China. The problem at the moment is a perception problem for investors, many investors who don't see this as tolerating weakness. They almost see it as engineering weakness, even if it isn't that. It's not a devaluation. It's none of those things. But these things can precipitate the kind of thing you're trying to avoid. The Chinese do not want 15-16 all over again. Could they get it?
Absolutely, they could get it. The first thing I looked at that this morning was 2015. I thought 10% on stocks. So is the market going to be down 1.5 to 2% and hold those losses today? 100%. And this now is going to probably go through for the next 2 to 3 weeks in August. I like the fact there is a September 1 deadline, so at least we know we've got to get them to the table. But this is absolutely real, and the Chinese know what they're doing. They absolutely know what they're doing, and they've had enough. That, to me, is the message, is that we have rights as well. And you know the next escalation of this is going to be rumours in the market about the fact they could then sell treasuries. I don't think that will happen, but that threat inevitably will come in the market as well.